Good morning, everyone. This is Financial Literacy 101. And this morning, we'll be talking about your debt to income ratio. I think this is a very important topic. I love these topics on Tuesdays and Thursdays. Kind of get me out of my investment sort of routine and rhythm. And I believe that those other parts of your finances, other than investments, savings, getting out of debt, debt to income ratio, understanding all these components of your financial well-being, your financial health is very imperative for your social economic status and understand how to level up. Essentially, you first must have a good base. You must have a good knowledge about things so you can be wise in decisions that you make each and every day. So let's get into this conversation, and hopefully this can help a lot of you to understand where you are and probably where you want to be. Well, first and foremost, ladies and gentlemen, I think one of the most important things we must understand is, where do you fall? What income range do you fall at? Now, a lot of you most likely was going to fall in one of these ranges depending on what group you belong to. Now, I feel connected to the $45,438, and I'm just going to use this particular number as an example. And these numbers are coming from the census.gov. Okay, that's the Census Bureau. There's done a lot of data and statistics. So this is accurate. This is probably the most accurate you're going to get when it comes to numbers according to income and dealing with particular groups that people belong to. Okay, we either be the census or the Federal Reserve. Let's move on. So we're just going to round down to $45,000 a year, even though when you're comparing and factoring your computing essentially your debt to income ratio, you do it prior to taking out taxes. It's usually your gross, but I'm just going to go with $45,000. Now, if you make $45,000 a year and you divide that by 12, essentially you should be making roughly around $3,750 a month. That's $3,750 a month. Now, when you factor in where creditors and other financial institutions want you to be below, which is 30%, they don't want you to be above 30% with the amount you have in your collateral credit. Meaning those things on your credit report is a tall tale sign. It is your financial report card to let creditors know, should I loan to you? Would it be for something of a personal item, like some of you guys want to be first-time or second-time home buyers, or you want to get a car, a boat, you may even want to get a jet ski, whatever fits your fancy. You guys probably want to know, where do you fall and how are they factoring these things in? Why can't I get a loan? This is probably one of the reasons why. It's because you are above that 30% threshold of where they would like you to be. Because we need to understand, these are numbers and you have to understand them, okay? You have to understand them. Now, let's talk about this for a quick second, because I think it's important for you guys to know. Now, with that being said, calculating your debt to income ratio and having your credit score in the front view, your debt to income ratio is an important part of your overall financial health. I mean, calculating your DTI, that's the abbreviation for debt to income ratio, may help you determine how comfortable you are with your current debt, and also decide whether applying for credit is the right choice for you. Because a lot of us go out, don't know what's going on in our finances, and we're applying for credit. And you have no idea. You can actually look at your credit score. You can actually look at your credit report and see all of the balances you have in your credit report. And you can do the computations yourself, and you just say, hey, you know what? I don't have enough credit. I'm not making enough money in order to go out and get another line of credit, order to go out and apply for another credit card, order to go out to get a mortgage, a house loan, a car loan, etc. See, do it yourself before you go and apply for credit and they deny you. And you're like, wait a minute, I pay all my bills on time. It has nothing about that. Now, that's a factor. Your credit score is always a factor. But again, they're looking at your credit report to see your debt to income ratio, how much debt, how much money you owe people versus how much money you have coming in. Very important. See, when you apply for credit, lenders evaluate your DTI to help you determine the risk associated with you taking on another payment. Now, when we're factoring in these things, folks, your debt to income ratio compares how much you owe each month to how much you earn. Now, specifically, it's the percentage of your gross monthly income, and that's before taxes, as we said before. That goes towards payments for rent, mortgage, credit cards, and all other types of debts. Now, when you add up your monthly bills, which, okay, may include monthly rent or a house payment, alimony or child support, your student, auto, and other monthly loan payments, credit cards, and you got groceries, utilities, gas, and taxes that may not be included into your federal taxes. You take those amounts, you divide the total by the gross monthly income before taxes. Key to that, before taxes. You divide by the total monthly income, which is your income before taxes. The result is your DTI, your debt to income ratio, which will be in the form of a percentage. The lower the DTI, the less riskier you are to lenders. Now, a lot of you may want to understand the different ranges that you may fall into, so let's do so. Now, the common number that most people know and understand is 30%. That's nationwide. That's doesn't matter what region, what county, what state, what city, wherever you live at, it doesn't matter. Everybody knows that 30%. But believe it or not, if you're still below 35% or less, you're looking very good. And that's relative to your income. Your debt is at a manageable level. They say, we're looking at your income, we're looking at all of these things, and you're below 35%. We see that you're managing your financials very, very well, because you most likely have the money left over for saving or spending, and after you paid your bills. Lenders generally view a lower DTI as favorable, as good. That means you can go out and buy that house. That means you can go out and buy that car, that jet ski. That means you can take out that business loan, okay, when it's usually 35% or less. Now, when you start reaching 36% to 49%, they kind of put this in the category of you can improve, you can do better. It's kind of like you have a B minus, C plus. See, that 36% to 49% is the opportunity to improve. I mean, you're managing your debt adequately, but you may want to consider lowering your DTI. This could put you in a better position to handle unforeseen expenses. Because, a lot of times people live in paycheck to paycheck, and one thing may occur in your finances, then all of a sudden you can't make none of your bills. All of a sudden a bill is missed. That looks very, very well when bills become 30 days late, 60 days late, 90 days late, and your credit score is going from 700, 680, 650, 630, 620, okay? Because if you're looking to borrow, keep in mind that lenders may ask for additional eligibility criteria, meaning like, okay, well, we see how much income you have. We somewhat see the assets. Is there anything else that you can offer us or show us to, kind of sway, kind of seesaw the pendulum, kind of pushes your way to give you this loan? We know you want to start this business, and we're willing to give you the money, but what we see on paper here, according to your credit report, is just not enough for us to persuade us. It's not enough data, information for us to really get out this loan, because our underwriters are like, and these are a lot of things that happens behind the doors, okay? What I'm talking about, ladies and gentlemen, these are a lot of things that happen behind the doors, meaning that these things you don't see. They're like, oh, our underwriters will not sign off on that, especially when you go get a car, or the underwriters. And the underwriters is the people who are making a decision for the people with the money. The people with the money like, hey, we trust you underwriters to keep our best investments at heart. Meaning when we give you money to loan out to people at a certain percentage rate, make sure my loan goes to credit worthy people. Okay, because there's these sectors and levels of people say, hey, I don't mind a risky loan every once in a while. Okay, so just keep that in mind. Now, that's this third category. If you are 50% or more, if you are 50% or more of your debt to income ratio, There's a lot of things you have to work on in your finances. And this is the reason why at every turn, everyone is saying no, 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 no. These are the reasons why. And the only people who will probably give you a loan is those loan sharks, is those payday loan places where they have your bank account information, your routing number information, because they know as soon as you get paid, they're taking their money right out of your account, okay? So when you're at 50% or more, there's a lot of actions that need to be taken. And of course, at this particular debt to income ratio, you may have limited funds to save or spend. So with more than half of your income going toward debt payments, which is very, very bad, you may not have much money left to save, spend, invest, or handle any unforeseen expenses. And see, ladies and gentlemen, this is the one factor that most people do not factor. Oh, my car window shield got broke. One of those rocks or pebbles off a dump truck or construction truck on the highway or the interstate. Okay, these are the things that you may not typically understand. Oh, I have to pay an additional amount for childcare this month because I didn't factor in X, Y, and Z. Oh, I thought about going to see my mom or dad, so I have to put my dogs and cats in this kennel, but I don't have the money. There's all these things that this may occur. Everybody have their own different lives, and you know some of the emergencies that may occur in your life. So I'm just trying to give you guys some examples, okay? But with this particular DTI ratio, lenders may limit your borrowing options. They say, you know what, you're asking for 10 grand, we can give you 2. You're like, well, I'm gonna need 10 grand to get my business off the ground. Sir, we can give you 2, and at that $2,000, we're charging you 8%, which is astronomically financially robbing you. 8% on a business loan is ridiculous. I wouldn't accept anything over 4.5, 5% at the highest when it comes to a business loan. Now, granted, dealing with type of business loan, I've seen some business loan depending on the amount. And when you start getting over maybe $150,000, $200,000, I can fathom maybe 6 to 10% depending on the contractual lending, not so much the amount, but the lending contract, meaning if in revenue, I'm getting into business. Let me back up. My apologies. I was about to get into some business things, but I really want to hone in and have you to really comprehend this debt to income ratio, because I've seen a lot of people, I mean a lot, asking me, hey, why aren't I getting these loans that I need to buy a house, to buy a car, to start my business? And the first thing I asked him, I said, well, what's your credit score? And then I start to peel back the onion to let them know this is the reason why. And debt to income ratio has been one of the main factors. Now, what's funny here is that according to your generation, according to your age, has a large factor. And I've been trying to really rationalize, why is it that people in Generation X, my generation, has the most debt? Now, this information is coming from debt.org, and they get a lot of their information from the Census Bureau, also other news agencies that people have reported things in. So you can go in here and reference this for yourself. But when I'm looking at Generation Z, okay, I can understand. Most of their debt, $16,000 as an average, is coming from student loans, okay? So I can understand that they're just getting out of the way, and most of these people are still in college, so these things has not computed. Now, that's the early, and a lot of people are not even dealing with Generation Z yet, but the millennials, okay, 87,000, that makes a lot of sense. I know a lot of millennials. A lot of the bills are from college, anywhere from $30,000 to $80,000. That makes sense to me. Then I get to Generation X, where we're kind of like in our midlife. You might as well put crisis at the end, because when I see $140,000 in debt, that is a crisis. Okay, that means that on average, that Generation Xers, 40 to 55 years of age, you guys are $140,000 in debt. $140,000 in debt. And of course, when I look at baby boomers, that makes a lot of sense. They're past their midlife. they're going into your senior citizenship, and they're paying down their home. So I can see that being significantly very lower than Generation X. And of course, the silent generation, 75 and above, of course, they paid off their homes. They're probably buying RVs to travel, or they maybe live with other family members, et cetera, et cetera, et cetera. So this is imperative that you guys know this information. It's imperative that you understand where you stand and how to combat those things. And it's very, very easy. I'm not going to give you any complicated answers here. I'm going to tell you to stop. Stop spending. Pay your bills. Stop living above your means. Pay down your debt. Pay down your debt. Pay down your debt. This is how you lift yourself to a new status. This is how you elevate yourself to a new level, is paying down your debt and stop all the damn spending. See, there's a group in here that I showed you before that I feel very connected to, that I have a very love for. Okay? And this particular group makes the less amount of money for more reasons than one. And of course, I'm going to break this down during my cigar talk, whether it be Friday or Saturday night. We're going to talk about debt to income ratio in a different light. But how in the hell you make the less amount of money, but you have the most debt in America? How is it you make the less amount, but you have the most debt in America? And that's why you need to understand financial education, aka financial literacy. You need to stop all the spending, pay down your debt, and stop living above your means, and start living below your means until you can live at your means. This is Financial Literacy 101. Learn money and be inspired. You guys have a great and wonderful Thursday. I'll see you this weekend. I'm out.